Welcome to the Steadyhand Coffee Break, a shorter, snappier version of our popular Steadyhand Cafe webinar series. My name is David Toyne, and I'm the Chief Development Officer for Steadyhand, located in our Toronto office. And welcome, Owen Winkelmolen. We're lucky to have such a great resource to help provide some context around the new FHSA, or First Home Savings Account, an account that is brand new to Canadians and one that Steadyhand is launching to our clients in the next few months. Now, Owen, before we dive in, please tell us a little bit about yourself, the work you do with your team at PlanEasy. So, for example, who do you typically work with? What do you do for them? And what's different about the service you provide from what you might get at a bank?
Yeah, great. Yeah, thanks, David. Excited to be here. So, PlanEasy, we are advice-only financial planners. We don't sell products, we don't manage investments, we just provide advice. And at PlanEasy, we work with a specific type of client. So we work with average Canadian households, typically from their mid-30s to 60s as they're entering into retirement and planning decumulation. We don't work with incorporated business owners or multiple rental property owners, but just very kind of average, typical situations. And what we're doing is we're helping our clients navigate, tax planning opportunities, government benefit planning opportunities, and just all the different accounts that they have access to, and really helping making the most of the money that they have and the competing priorities that they might be facing.
And in addition to the great work you do for your clients, you also have a fantastic blog on your website. We'll link to that so that if anybody wants to know more about virtually anything related to finance and financial planning in Canada, PlanEasy is the place to go.
Thank you.
So let's dive into the FHSA, and let's start with just the basics, the why and the what. Is this a federal, provincial initiative? What's it designed to accomplish, and who's eligible to have one?
Yeah, federal initiative introduced as an idea first in 2021, got passed in legislation in 2022, and 2023 is the first year that the First Home Savings Account became available. Now, the account is really, like the name suggests, it's for first-time home buyers. It has a lot of the same eligibility rules as the old RSP home buyers plan. So you have to be a Canadian citizen or resident, you have to be over the age of 18, and like the home buyer plan, you have to have not owned a home, principal residence, in this year or the 4 preceding years to be able to open an account. Now, there's a lot of edge cases there. So if you own a rental property but not a principal residence, or if your partner, common law, or spouse owned a property, there are some edge cases. So if that does apply to you, definitely reach out to an advice-only planner to see if it applies.
Fabulous. So there's a lot of complexity here. So your point of reaching out to get some help is a good one. Your blog does cover a lot of this, but can you just give at a very high level, how does the plan work? Like, how much can you contribute? What are the tax benefits of the plan? How does income get generated in the account, and how does that get taxed?
That's right. Yeah. So it's a unique plan. I would say it's a mixture of an RSP and a TFSA. So a mixture of a registered retirement savings plan and a tax-free savings account. When you make a contribution to the First Home Savings Account, it's a tax deduction on your tax return. So you get a nice tax refund for making a contribution. And when you make a withdrawal for a qualifying home purchase, so for your first home, you get to withdraw that money tax-free. So kind of like a TFSA when you're making a withdrawal. Now, the benefit here is that there's a lifetime contribution limit. So each person can contribute $40,000. And the annual limit is $8,000 per year. So if you kind of think about it, you need 5 years to maximize the value of this First Home Savings Account. So it does require a little bit of pre-planning if you've got a home purchase coming up in the next 5 to 10 years. Now, the other unique thing about this account is there is a 15-year maximum. So even though you can open the account at age 18, that's something you probably want to reconsider unless you're planning to purchase your home in your early 30s. So we often advise clients who are kind of in their late 20s that maybe now is the right time to open a First Home Savings Account, because you're probably going to plan to purchase that home in your mid to late 30s anyway.
Okay, so it's not really something for an 18 to 25-year-old necessarily to get too excited about it.
Probably not the best time. I would say
Right.
strategically, and this is where we can, use all these different accounts in a strategic way.
Yeah.
I would probably recommend, unless there's a unique circumstances, that your 18 to 25-year-old is leveraging a TFSA,
Right.
and then maybe shifting to a first home savings account later on, after getting their first job and income is higher.
Okay. Okay.
Yeah.
Well, and we'll go through 5 scenarios that you've laid out in your blog, and sort of tease some more details out of this. But one of the challenges that I've found with the TFSA, and maybe it will also be with the FHSA, is that people focus on the S, the savings part. What,
Yes.
yeah, what's your sort of general thinking around what you should be doing with the money that you contribute into the FHSA?
Yeah, that's a good question. So unlike maybe an RSP or a TFSA, which have perhaps a longer investment horizon, the first home savings account, by definition, might have a shorter or medium term investment horizon. So really need to keep that into account when making investment decisions within the account. So something that's going to be available when you're looking to purchase that first home that maybe isn't going to lose principal as an investment, but still is providing some growth. The growth within the account, if withdrawn for a first home purchase, is completely tax free. So, getting growth, some good growth within the first home savings account would be beneficial. But at the same time, you need that money to purchase a home. So the amount of risk that you're taking needs to be in line with that goal.
Right.
Yeah.
It's probably oversimplifying it to say that the FHSA brings together, marries the best of the TFSA and the RSP, but there is a lot of interesting connections between the two, and
Yeah.
we'll tease those out in the 5 scenarios that you discussed in the blog. Can you tee up the first situation or scenario for us, and what you're thinking there?
Yeah, so the first situation is your typical use of the account. So it would be your individual or your couple looking to purchase their first home, and their goal obviously would be to think at least 5 years in advance and make those $8,000 contributions to get the full $40,000 in the account, plus growth. So in the blog post, we go into a little bit of detail, but imagine you're in your first job, you're earning somewhere in the 30% tax bracket. By making $40,000 worth of contributions to the first home savings account, you should expect about $12,000 in tax planning benefits. So an additional tax refund, which maybe goes into a TFSA also for that first home purchase. So now you're sort of leveraging that and
Right.
ending up with maybe over $50,000 for your down payment.
That's very cool.
Yeah.
And then the 5 years goes by, you find your house, you take it out, and lo and behold, you've got this potentially $50,000 nest egg. There's no tax. Well, actually, hopefully it's growing to
Yep.
maybe 60 or 65 or 70,000. And yeah, so just thinking about that, will a lot of people be tempted to put this this money into like cannabis stocks and things to really leverage it up?
I think there could be that temptation. I think the risk there is you're going to lose all the benefit of that tax-free withdrawal. So, like any sort of good investment planning, we want to think about the investment horizon, what that money is used for. Really, it's a short, medium-term horizon. So, investing everything in meme stocks or cannabis is probably not the best decision.
Right. So be prudent and thoughtful.
Yes.
Situation 2. Okay, so I have 4 kids. They're knocking on the door. Help! What's scenario
Yeah.
number 2?
Yeah, so scenario 2 would be a parent who wants to help with a first home purchase for their children. So, first job, maybe your children don't have the cash flow to maximize the account. A parent could theoretically gift their children $28,000, for instance, as after tax, an after tax gift. There's no inheritance tax. You can gift that over to your adult children. And those adult children could use that to maximize their first home savings account. So what they could do is they could get the tax refund. They could use that $28,000 gift and essentially end up with $40,000 of pre-tax contributions to their first home savings account. So that's one way that you could, as a parent, leverage a smaller, sort of gift, along with the tax advantages of the first home savings account, to turn this into a much larger gift down payment in the future.
Okay, so just to be clear, the parent or the grandparent is not gifting the 40,000, they're gifting 28 and then sort of leaning on tax refunds to balance it out to 40.
That's one opportunity. I mean, you could
Yeah.
obviously gift a larger amount, but
Yeah.
I think that the leverage there is the tax return, the tax refund that gets
Right.
generated,
Yeah.
almost adding to that gift. Yeah.
Okay, great. Well, that should create some interesting Sunday evening dinner conversations at the family table.
That's right.
Third scenario is probably something that a lot of people living in high-priced GTA and GVA are considering, which is to buy later in life. So do you want to run us through that?
Yeah. So although first time home purchase, we often think of individuals, couples in their late 20s, 30s. There is no limit on the account except for that 15-year limit. So
Okay.
if you have not purchased a first home, if you qualify as a first time home buyer, you could theoretically open this account in your 50s, 60s, 70s, and still get all the tax advantages as a first time home buyer. So somebody planning to purchase a home a little bit later in life can still get all the benefits of the first home savings account.
Great. So even if you're in your 50s and 60s and haven't bought a home, that's great. What about the
Yeah.
fourth scenario, which is looking at Canadians buying a home, but who have a lower income, so may not benefit as much from the tax rebate?
Yeah, so an interesting sort of conundrum for lower income individuals and couples is that RSPs are not very attractive. RSP withdrawals in retirement cause guaranteed income supplement, GIS clawbacks. Those clawbacks are 50 to 75%.
Right.
But we come across a lot of clients who, for whatever reason, they have money in an RSP. They might have contributed that previously. One of the interesting opportunities, tax planning opportunities with the first home savings account is that you can transfer from an RSP to your first home savings account on a tax deferred basis. So theoretically, you could have a lower income individual or couple. They want to purchase their first home. They have money in their RSP, which isn't actually that useful in retirement. It causes a lot of clawbacks. They could theoretically shift that money, $8,000 a year, into their first home savings account up to that $40,000 limit. And then they could withdraw that all tax-free, no government benefit clawbacks, no taxes on that withdrawal. So again, somebody who's purchasing a home a bit later in life, who happens to be in a lower income with a bit of RSP assets, it does open a new planning opportunity.
Okay, that's planning. That's really basic
Yeah.
planning. That's very helpful.
Yeah.
The challenge with the FHSA contribution catch-up rules might bite you though in that scenario, because you may want to shift all $40,000 from your RSP or 30,000 all at once, and you can't quite do that.
That's right. Yeah. So at most you can catch up 1 year at a time. So 16,000 would be the largest contribution you could make. And that's only if you've had the account open for the previous year. So again, requires some pre-planning. You want to think about this in advance, really map out the different pieces. But we're talking about, $12,000 to $20,000 of, tax planning or government benefit planning opportunity.
Okay, and that brings us to the final scenario, which is really interesting because you suggest that lifetime renters, people with no expectation of ever buying a home, but with high incomes, can benefit from opening a FHSA. So what's that all about?
Yeah. So it's an interesting planning opportunity. Again, not the intention of the account, but the way the rules are set up, it creates an opportunity for individuals or couples who never actually plan on purchasing a home. So I think in the blog post, I had suggested that this might be, somebody who's traveling, who's
Mm,
financially independent, and who doesn't necessarily have a home base in Canada, but they're planning to rent long term. For those types of situations, the first home savings account is still an opportunity because after 15 years, which is the limit of the account, the time limit of the account, the first home savings account will simply roll into an RRSP. So by maximizing the first home savings account, it's like getting an extra $40,000 of deductions, tax deductions, and tax deferred growth, which just ends up back into the RSP in the future. Yeah.
Oh, that's very cool.
Yeah.
Another great planning tip.
That's right.
Well, Owen, there are lots of considerations that one would use to decide about opening an account and how to get the money working for you. We talked about whether you should be investing it, putting in a GIC or savings account a little bit. We talked about whether people should be taking big risk with meme stocks or otherwise. And we've said, no, this is a very sort of shorter to mid-term kind of proposition, and we need to be prudent around that. But how does the FHSA interact with other home buyer assistance programs, such as the Home Buyers Plan or any other government initiatives that are out there to help people with their home purchases?
Yeah, that's a great question. So originally, when the first home savings account was introduced, you couldn't stack the first home savings account and the home buyer plan, the RSP home buyer plan. So for those who aren't familiar, the RSP home buyer plan allows you to withdraw $35,000 from your RSP. It does need to be paid back over the course of 15 years. But again, you get the tax benefit there of making those contributions and potentially boosting your down payment. So there was a change. The legislation now reads that you can have both the first home savings account and the RSP home buyer plan at the same time, which potentially leads to a total of $75,000 per individual that they can withdraw for the purpose of a first home purchase. And again, both receiving tax deductions, tax advantage. So there's a potential there that a first-time home buyer individual has $75,000, a couple has $150,000 for a down payment on their first home.
Beautiful.
Yeah.
And in your experience talking about this new account type with clients and colleagues, are there common misperceptions or pitfalls that individuals should avoid when considering an FHSA?
I think a bit of the advanced planning is important. So deciding when to open the account, deciding when that first home purchase is planned to take place. Because of the 5 years required for the contributions to maximize the account, you do want to think a little bit in advance. So of course, as financial planners, we're doing that. We're thinking 5, 10, 30 plus years into the future. But often, if that isn't top of mind, or if the rules of the account aren't top of mind, there's a potential to miss out on those types of opportunities. And the tax refund alone is worth, $2,000 plus each year. So, missing those opportunities can be quite costly, or at least, make things a little bit more difficult than they need to be.
Yeah, fantastic. Any other final thoughts as we wrap up our coffee break?
No, I think that's a good summary. It's a great account. I think for first-time home buyers, it's a real advantage. I would definitely recommend talking through with somebody on how you can use that account for your first home purchase. And for parents who are looking to help out their children, it's a great way to maybe provide a smaller gift that can, through the tax refund, get leveraged into a much larger down payment.
Yeah, brilliant summary, Owen. Thank you. And thank you for your expertise on this emerging topic. It's enormously helpful and greatly appreciated. And Owen, if anybody wants to connect with you, what's the best way to do that?
Yeah, so just go to planeasy.ca and click Start Planning, and you'll be able to set up an account with us and book a discovery call. Yeah.
Cool. Well, we'll include a link to your contact information in the description on our YouTube video, which will be below this in the video. And thanks to everyone for watching the Steadyhand Coffee Break video on FHSAs. Owen and I have also discussed the GIS, or Guaranteed Income Supplement government benefit for seniors, in another complimentary video that you can find on the Steadyhand YouTube channel. Now, you don't have to be over 65 or a senior to care about GIS. Maybe your parents are eligible and they don't know it. So head over to that video and check that out. And there are many other investment and financial related videos and resources that you can find on our YouTube channel, as well as on our website, steadyhand.com. So be sure to subscribe to the channel and/or to our blog to be kept up to date on all things related to investing and planning. Owen, thank you again, and thank you all for watching, and bye for now.